Welcome to the CU 2.0 podcast.
Hi, and welcome to the CU 2.0 podcast with big new ideas about credit unions and conversations about innovative technology with credit union and fintech leaders. This podcast is brought to you by Quillo, the real-time loan syndication network for credit unions, and by your host, longtime credit union and financial technology journalist Robert McGarvey. And now, the CU 2.0 podcast with Robert McGarvey.
The Student Choice CUSO, built around student loans, is expanding. It's now introduced a program that will enable credit unions to issue small dollar emergency loans to members with no credit check. No credit check. And yet, these are not payday loans. Interest rates are capped at 18% per NCUA policies. How can this be? On the show is Scott Patterson, CEO of Student Choice. The episode starts with a view into the current state of student loans and big changes that are transforming that market. But Patterson came on the show to talk up the new employer choice program that will enable credit unions to make small dollar loans to employees of SEGs and to do so with little risk. Little risk. What kind of voodoo is this? Patterson explains it's definitely not voodoo. The key is that the lending is tied into the employer's payroll system. Yep, there's no credit check, but instead there are employment-based underwriting factors, including job tenure, income stability, and employer characteristics. Patterson elaborates on this in the show. The first credit union up with employer choice is Affinity Plus Credit Union in Minnesota, which Patterson indicated has started by offering the programs to its own employees. Other credit unions, says Patterson, want to start by offering the program to SEGs. We'll set this up as an employee benefit. In that process, says Patterson, this has the potential to become a new member acquisition tool. Remember this, estimates are that half of American families do not have $1,000 on hand for emergencies. A friction-free emergency loan program just might be the life raft many families need. And, says Patterson, credit unions can play a big part in helping out those families in need and doing so at small risk and also low interest rates. Listen up. You have 12 credit union owners, if my research is right. True?
Correct. Yep. We're a CUSO, multi-owned CUSO.
And are they... Most of the names I saw are pretty big credit unions, like Digital.
Correct.
And did this business pivot, did that involve approval from the owners? I assume so, but just I'll ask the question anyway.
So basically, so maybe your question is more of what does this mean for student choice? Because this isn't a student loan, right?
Right.
And so for nearly 2 decades, we've helped credit unions build and scale specialized lending programs. And student loans are a really important part, but a relatively niche area of lending for most credit unions, when you compare it to, auto or mortgage or credit card lending. And as we talked with our credit union partners, we realized that our core competencies were not just only in the area of student lending, but also specialty niche lending, right? We make it easy for credit unions to launch and successfully manage new loan programs without large investments of time and staffing expense. And so with employer choice, we're bringing that expertise to financial wellness benefits, leveraging the credit union relationship with employers and their SEGs to serve new members in their field of membership. So, as we looked at, why do credit unions like us? Why have we been successful over the years? It's not just student lending and student lending competencies, which of course are important in the area of student lending. It really is this more niche area where it's not a core loan product for the credit union necessarily, but it does require, specialty niche lending knowledge and know-how, and importantly, make it easy for the credit unions to get engaged and do it with ideally a CUSO partner.
How robust is the student loan market today?
You may have seen in the headlines in the news, the one big beautiful bill that was passed last year is dramatically changing the private student loan market starting this July. So prior to this coming July, in the graduate school area especially, students had access to what was known as the Grad Plus loan, which would cover the full cost of attendance. And that's basically going away starting for incoming graduate students in July of this year. And what that means is, just like in the undergrad market today, where you have students going and they have some savings, they get their government Stafford loans, right, which are capped each year. Generally speaking, there's a gap, right, that they have to finance separately, and that's where private student loans come in. But prior to July of this year, that gap was really only there for in the undergrad world. And now all of a sudden in the grad world, that's going to be the same, because the government loan will not go up to the full cost of attendance anymore. So it's expanding, and it's about to expand pretty dramatically. Student lending as a total, or private student lending as a total industry, is still relatively small, related to, auto loans or what have you. You're looking at a total annual market of about, let's call it $14 or so billion a year in private student loan originations. But again, most of that has been in the undergrad area because of the government financing caps. And that's about to change. So you're likely to see that potentially double over the next few years because of the grad market and the expense of grad school.
What's the default rate on student loans?
Well, if you're talking about, so there's two types of student loans that are really important to understand. There's the federal student loan programs, so federal loans, and then there are the private loans. Federal loans don't really employ credit-based underwriting, so it's really an access solution that the government is making available to families and students as a public policy. But because there's no real credit-based underwriting or underwriting that we would look at in the crediting system as being for underwriting a loan, the default rates and delinquency rates in the federal student loan area are pretty abysmal. On the private lending side, those are credit-based underwriting. If it's an undergrad student, 18, 19 years old, oftentimes there's a cosigner on the loan, mom or dad. So the credit unions and banks that do private student lending are, underwriting those loans and looking at, ability to repay and all of those factors. So the performance is significantly better. You'll see quite commonly delinquency rates, well below 2% for most private student loan portfolios, and default rates, obviously less than that.
That's not bad, really.
It's apples and oranges when you talk. People say student loans, right? And well, clarify, what are you talking about? Are you talking about private student loans? Or are you talking about federal student loans? Because they're very, very different types of loans with very different, objectives, right? The credit unions and the banks that do private student lending are, want to be sure that they're not providing too much credit for people that, might have challenges in repaying in the future. And they also want to be sure that it's going to be a sustainable program, right? The loans that they're making have to be repaid. And so the government doesn't look at it with the same calculus. It's more of a public policy benefit and the ability to provide access to families. But a lot of the horror stories that you'll read in the media around people that get into trouble with their student debt, and it's crushing debt burdens, et cetera, and they can't repay. It's oftentimes those federal student loans, because the access is so easy to get the money. There's not really any underwriting that's trying to help determine, is this loan going to perform? Is the student going to be able to repay this once they exit school?
Yeah, I remember some years ago I wrote a magazine article about law school students and student loans, and these were people graduating from, let's say, tertiary law schools, and they owed like 250,000, 300,000 when they graduated. And they were doomed financially. They weren't finding the jobs they thought they were going to be able to get. Although even that was kind of a fantastical thought. You don't graduate from a mediocre law school and suddenly get paid $250,000 a year. It doesn't work that way.
Right. Yeah. And most of those, and again, that's in the grad school side. So most of that has been what we call the Grad Plus loan program, the federal student loan program, which again goes up to the full cost of attendance. So you're going to law school and maybe there's $60,000, $70,000 a year, full cost of attendance, including, your room and board, et cetera. That adds up. but the money's there, or has been there up until this coming July.
So now you're continuing your student choice business, but grafting on this new business, employer choice.
Absolutely. Yeah. Student lending. And we work with nearly 300 credit unions today and help them with their student loan programs and portfolios. But, employer choice is something, entirely new and exciting. Employer choice, it's an exciting new solution from the CUSO that's designed to help credit unions establish and expand relationships with employers and their employees. Now, those can be entirely new relationships with employers in the credit union communities, or it can be significantly enhanced existing employer relationships that credit unions may already have. So, for example, seg relationships that the credit union might have, or where the credit union is able to serve the workforce at an employer as part of their field of membership. Robert, as I said, we're a multi-owned CUSO. We're designed, we're owned, and we're directed by credit unions for credit unions. And in this case, employer choice is the result of a collaboration that came from a steering group of 16 large credit unions across the country, representing around 5 million members over the past year and a half. And the primary goal with employer choice is to support credit unions in their drive to improve the financial resiliency of working Americans and to help credit unions grow new member relationships with the workforce in our country. So employer choice enables credit unions to partner with employers to provide new employer-sponsored benefits to their workforce that come in the form of what we believe is a really new, innovative credit union solution that's designed to meet the financial needs of employees and their employer.
And my sense is that an initial market in many cases will be the credit union itself. Am I right?
Yeah, so this is an entirely new solution. We're just rolling it out now. So you saw the press release probably a couple of weeks ago. This is something where I mentioned the 16 credit unions part of the steering group. We have several of those credit unions saying, okay, we're going to start and roll this out to our employees at our credit union first. So we really understand how it works. We can tweak anything if we need to tweak anything, but they want to provide this as an employer benefit to the credit union's employees first. But the ultimate goal is to roll this out to their segs and new employers that the credit union may not have a relationship with currently in their communities, to be able to offer as a new employee benefit to those employees.
Yeah, I saw an American Credit Union's number. If I remember it correctly, it's that the average salary in a credit union is $78,000 a year. I don't know how they calculated that average. And I would think the majority of the workers in a credit union are making significantly less than that.
Probably, yeah.
It's more of a pyramid in terms of salary. So the CEO makes a lot of money in many cases, particularly in a big credit union. Mm-hmm. Whereas the teller does not make a lot of money, and there's a heck of a lot more tellers than there are CEOs. So
that's right. Yeah, no, it's probably, I don't know how they do the analysis there, Robert, but I'm assuming it's total comp divided by total number of full-time employees.
That would be my guess. Yeah.
Yeah.
Yes. Yeah.
And, I think, so this concept of what we're doing here, which I'll explain in a minute and how it works, but is not a new concept. This has been in the marketplace for, over a decade. It's just that credit unions haven't been doing it. It's been fintechs and some banks that have been really focused on this area. And what we're trying to do is get credit unions into this space. But the data is out there about how this type of loan performs and what the need is and who needs the loan. And most employers are shocked when they roll a solution like this out about how much need is actually there, from their employees.
They shouldn't be. They really shouldn't be. I'm an old guy. I remember where every factory in New Jersey had a loan shark who would lend money on Monday because you needed money because payday was Friday and you blew it all over the weekend. Yeah, that's
just it.
And they all had this guy who was viewed as a benefit to the community, believe it or not. So it's kind of ignorant not to realize that many employees have some serious problems. Now, back in the 50s, you didn't have a credit card that you could extend your, cover some expenses during the week, even though you're broke. But the need has always been there. Now, there are solutions to this already
Hmm.
in the market, including some credit union birthed and owned solutions, right?
Sure, yeah. There are what are known as payday loan alternative programs that some credit unions have launched
Right.
that do, and NCUA has a program for PAL or payday loan alternative options there for some credit unions that they can explore. There's other organizations out there trying to address this need in different ways than what we're doing here. It's getting back to what you're saying earlier. It's quite common for a program like this to roll out, and all of a sudden, 20% of the workforce has adopted it within the first year. So the
Wow.
need is definitely there. It's real.
Well, yeah,
Um,
I live in Phoenix, and in Arizona, payday loans are illegal. But man, we got title shops, we got pawn shops, you name it. There's a zillion ways to get money. And obviously, people are using those places since there's so many of them open. So,
yeah, yeah, yeah. Employer choice is designed to help credit unions effectively serve that need with much fairer terms and in really a sustainable way that helps the employee successfully navigate, what we call financial shock events, right? And in our case, it's through employers as an employee benefit. I mentioned earlier, these are going to be done as employer-sponsored benefits. And so, what do I mean by employer-sponsored benefits? Just as employers offer, health insurance and retirement plan benefits to support their employees' well-being, there's also an increasing need to support employees' immediate financial stability, right? Employers know that financial stress is on the rise for many Americans in the workplace, with many living paycheck to paycheck. And I think you and probably most listeners on the pod here are probably already well aware that workers often face unexpected financial shocks. The data shows that roughly 60% of Americans experience a financial shock each year, and more than half of Americans lack enough savings to cover $1,000 new necessary expense that they weren't anticipating. And so, for example, that this could be an unplanned auto repair, or it could be a new hot water heater replacement, or a surprise medical bill, or any unanticipated financial need that they'll have a need for financing to manage. And of course, the challenge is magnified further if the employee has poor credit, right? Nearly a third of Americans with credit scores, and those are the ones that have a credit score, have a score of less than 670, and around 12% have a thin file or no score at all. And this is despite many of those same people having steady incomes, right? They're employed, they get a paycheck. And now, today, to manage these events, as you were saying, millions of employees are forced to rely on predatory lenders and other exceptionally high cost forms of short term debt. These are the payday loan lenders out there, the paycheck advances that are there, title loan companies, as you referenced. So employers know that these unexpected personal financial shocks are happening regularly to their employees. They may not know how much it's happening because employees are generally, they don't want to talk to their employers necessarily about their financial problems. But the employers know that this has a direct impact to their overall well-being, their productivity, even retention.
oh,
But
sure.
but on the flip side, the employers, they also know that when their employees are financially well, it increases employee productivity and retention. So the solution here is, how can credit unions help address this financial well-being need of employees and their employers? And that's really where employer choice comes in, right? We're bringing credit unions into this equation and enabling them to deliver transparent financial solutions through the workplace, and create truly a powerful member growth channel for the credit unions in the process. And our flagship solution is a payroll integrated, no credit check lending platform that enables credit unions to serve workers through their employers' existing benefit channels. So connecting employees through payroll systems, and payroll connectivity, Robert, with the credit union is the key here. That enables borrowing, payroll connected repayments, and even payroll connected savings to occur, seamlessly. Again, all within the employer's benefits channel. I think I mentioned earlier, we want to support credit unions in their drive to improve the financial resiliency of working Americans. And remember that most credit unions were founded on the principle of people helping people. Right? I've been in the crediting system my whole career, 30 years. That's been the mission. That's been the movement, right? To provide affordable financial services to working class communities. And most credit unions have origin stories where the credit union was created to serve employees of a particular company or organization within the community, maybe 40, 50, 60, 70, in some cases longer years ago. Employer choice builds on that mission and impact by enabling credit unions to just dramatically enhance and build their relationships with employers and serve their employees. And so in some ways, we believe we're helping reconnect the movement with its workplace roots and see those connections or see those relationships as growth opportunities for the credit union to help them serve more members and help them solve some of our society's biggest financial challenges that people are facing. Again, a lot of those folks that are living paycheck to paycheck and can't weather these financial shock events that happen. In some ways, I like to say, Robert, it's sort of back to the future, right? And our roots as a movement to serve these people through their employers.
Now, if a credit union wants to jump into this, what expenses does it face, and what expenses would the employees who avail themselves of it wind up paying?
You're talking about how we charge the credit union? Is that?
Yes.
Okay. So the credit union is going to pay there's a small onboarding fee because it does take time to establish the connectivity with the payroll system that the employer is using. So we're mapping all that out with our systems, and the credit union will pay a small origination fee for the loan, and as well as a monthly servicing cost for the as long as the loan is active. In terms of the employees, when they take a loan, there's no fees for them. They can repay at any time. There's just, it's in our case, a simple installment loan where there's an interest rate the credit union is charging on the loan. And again, we're talking, in this case, it's not what's known as a payday loan alternative loan, as how NCUA defines it. So these would be, conforming loans below, somewhere below the 18% cap
that's very different than many other products. Very appealing interest rate. So.
Yeah, and again, payroll connectivity is the key because repayment is happening automatically through the payroll system. So in the same way that the government takes out Social Security, Medicare. Maybe the credit union has a health plan where the employees charge something, or vision, those types of payroll deducted benefits, the loan will be repaid in the same way. So over the course of, in this case, for most of the credit unions, it'd be 12 months. So
when will your first credit union be up and running with this?
June 1st.
Oh, wow. And
June 1st,
what credit union is that?
Affinity Plus in Minnesota.
I see. And do you have any others in the queue?
Yeah, Credit Human in San Antonio, Texas, and the others I don't have permission to share who they are yet from the confidentiality. Right. But yeah, there's a number of credit unions we're talking to that are excited. Some are planning to roll out to their employees first, and others are much more excited about. They're already talking to their SEGs and business relationships in their communities.
I can really see it working very well with credit unions' own employees. We'll see how it goes with SEGs. I'm not saying I'm pessimistic about it. I'm saying I'm just more uncertain about it.
Well, it's sort of interesting because, like I said, this exists out there in the employer benefits world, this type of product. The challenge for a lot of employers is that who's the lender and do they have the best interests of our employees at heart?
Yeah.
And as you might imagine, some of the providers in this space are really more, they're kind of like a modern day payday loan company, right? So we're not talking about 18% or less interest rates. We're looking at much, much higher cost of credit. It's just happening through the employers. So the employers are very sensitive to that. The credit unions being a part of this actually is something the employers that we've been talking to are very excited about.
Oh, well, the interest rates you're talking about put it in a whole new space. I
That's right.
remember some years ago seeing a TV ad, and I'm blanking on the name of the company, and it had a tagline something like, "Your rates are higher, but we approve almost everybody," or something like that. I said, what could that possibly mean? I remember doing a little research, and the rates were well over 100% per annum. I mean, it was like, what the hell? I mean, if I'm an employer, I don't want to offer that product to my employees. Absolutely not, because could they ever pay this off? Whereas if you're talking about something under 25%, the numbers become bearable.
And again, these are no credit check loans that the credit union will be doing. And again, payroll connectivity is the key there. And again, all of these are employees that have, they're paid regularly, right? They just are living paycheck to paycheck. They're not saving money. And then these shock events happen. So one of the things I think that I want to address, Robert, is just risk, right? And really just underwriting, right? I said no, it's a no credit check loan so that we can help serve those people with not great credit or no credit even through their employers and the employer's benefits channel. And I want to address risk since I'm sure there's many, who are listening to the podcast who are going to wonder, how can I successfully underwrite a loan to an employee that may have poor credit or no credit score at all? And it's a great question, right? Traditional personal loan underwriting clearly does not work if you're trying to serve employees who already can't qualify for loans based on their credit score. So this is how this is being addressed. First, there is underwriting being performed here, right? The model works because we're underwriting both the employer and the employee. For the employer to be eligible, we want to know things like, how long has the employer been in business? How many employees do they have? How many are full-time versus part-time versus seasonal employees? What's the annual turnover rate at the employer? What kind of payroll system do they use? Is the employer itself in good financial standing, right? And for the employee, we want to know some things as well. We want to know, how long have they been employed? What's their payroll frequency? How much do they earn each paycheck, right? And we can do underwriting based on that. And this is all part of the automated payroll file integration we make possible between the credit union and the employer. So yeah, no credit checks required, and the credit union is making unsecured loans in some cases up to $5,000 or whatever the level is the credit union sets. But eligibility is based on income and tenure. So where the amount they'd be eligible for is based on a percentage of their paycheck repayment. And the key to a sustainable program and performance is that payroll integration for repayment. And I can't stress that enough. Like, why is this? How can the credit union charge 18% or less on these loans and see really good, phenomenal, in fact, performance on these portfolios relative to some of the other types of payday loan alternative type programs credit unions might be doing? And again, it's that payroll integration is the key. The loan is automatically repaid as part of the employee's regular payroll deduction. Again, just like how automatic deductions in payroll are handled already for Social Security, Medicare, healthcare, vision, any other payroll deducted benefits. So for the vast majority of these borrowers, the loans will be repaid over the 12-month installment period without the employee needing to do anything. If a small percentage of these employees, leave for another job or for any other reason, the loan is only then repaid as part of a traditional repayment where the borrower, sets up an ACH or pays the amount due manually. In our underwriting of the employer and the employees, we're really looking at what's the likelihood that this person is still going to be at this employer or employed over the next 12-month period. So you can look at tenure. Well, they've been here for 5-6 years at this employer. They make this amount of money. This is how frequently they're paid. The chances are very, very good, right? So for whatever portion of that portfolio that, stays the full 12 months, the repayment is basically 100%. It's the remainder that isn't there for that full 12-month period. That's where you have some risk, right? And you need to so it's really key to understand, how is this different than other types of payday loan alternative programs that might be out there that credit unions are doing? How can this perform so much better? And how can the credit union charge such a low interest rate, relatively speaking, for this type of need without a credit check even?
Is Affinity Plus rolling this out to its own employees first?
That's right.
Is there any data on creditworthiness of credit union employees? I'm asking if they're more scrupulous about trying to pay off their debts than other kinds of employees. I mean, you might be if you live in a world where that becomes a top of mind issue.
Yeah, I'm not familiar with any data on that, but it wouldn't surprise me, right? In the case of the credit unions offering it to their own employees, I would imagine, the company you work for, probably like getting an auto loan, right, from the credit union you work for. You probably don't want to go delinquent or default on that with your
Exactly.
employer. Yeah.
And you also understand what that means. You understand the process. It's not something that is just this kind of nebulous threat out there. This is a reality that you probably are familiar with through the members of the credit union, not personally yet. So how long did it take to get Affinity Plus up?
As one of our leading credit unions, right, it probably takes a little longer than it does the second, third, or fourth time.
Right. Sure.
But we project it'll take the typical credit union, a month or so. We can do most of the heavy lifting, but this has to go through compliance and all the other sorts of things that a credit union would do to make sure that everything's buttoned up. But most of the work is done on our side, and the credit union's primarily reviewing and then also obviously setting whatever lending levers or underwriting related levers they want to put in place. So it just depends on how quickly the credit union wants to go. On our side here, it's probably about a week's worth of work and that's it to get a program up and running.
Staff involvement is there on the credit union's part? And I always ask because a lot of good fintech initiatives die, not because the credit unions don't like it, but because they don't have the manpower to implement it.
Yeah, so it's designed to be.
Right now, AI is sucking up every available hand in a lot of credit unions. And it's like, hey, come back next year, man. Maybe we'll have this AI thing sorted by then.
Yeah, it's designed to be minimal on the credit union side. We're doing a lot of the work here at the CUSO. That's why, that's how we're compensated, obviously, just like on the student choice and the student lending side. But it's something that the credit union has to want to do, obviously, and will require some effort on their part. But for the most part, it's designed to be minimal effort from the credit union's perspective. The real, if there's a heavy lift, it's the relationship generation or the relationships with the employers, the SEGs or the businesses in the community that the credit union can serve.
Now that's a separate, more complicated problem, I think.
Yeah, but that's one where again we do most of the work, but we can help the credit union form those relationships. In fact, we're forming alliances and partnerships with benefit brokers, where we hope that and expect that the employers will say, yeah, we want to do this with a credit union. They come to us and we get to find them a credit union. So it's not just a credit union necessarily going out to find their employers. That we hope to be bringing employers to credit unions as part of this process. But we have to integrate with that employer's payroll system, right? Whether it's ADP or any one of a number of different payroll providers that are out there. And we know how to do that, but it does take, a little bit of time. Some HR departments at larger employers are very comfortable. They do this all the time with other benefit providers they work with to provide access and integration with their payroll to provide these benefits. But others, smaller employers are less familiar with that, and we might have to be working with them and maybe their representative from their payroll provider to get all the integrations needed to make this work the way it's intended to work. But it's not insurmountable. It's not unknown. Like I said, this isn't something that people or HR level folks aren't familiar with, but it does require a little bit of upfront setup, right? And get it off the ground. But once it's off the ground and running, the system is 100% automated. So really low effort on the part of the credit unions after launch.
Now, my guess would be, if I'm a SEG, I'd rather wait until Affinity Plus it has been up and running for a while with its own employees. So there's some data that tells me this actually works.
Well, like I said, this isn't new. This is something that's existed for a decade or more. It's just that credit unions haven't been a part of it until now.
Right. Yeah.
So I think the credit unions we're working with have been doing lending for many, many years. This is something where I think the employers that want to do this would rather do it with a credit union than anyone else, frankly. Certainly, just like any startup, which is what we are right now in this solution, your first several employers are going to be the hardest part to get the ball rolling, right?
Oh, yeah. I always tell fintechs the hardest sale you're going to make is the first credit union, and then the second one is pretty hard too. So it gets easier incrementally.
Mm-hmm.
So you already were in the credit union universe, and you had credit union owners, which really just gave you a whole lot of speed out of the starting gate.
Yeah.
So, now, what's your employee headcount increase in starting this program?
We're leveraging a lot of the employees we already have. Like I said earlier, we have a lot of niche lending specialists that work for Student Choice in all areas of operations, marketing, client relations, sales, legal, regulatory compliance, all of those things. So it's only a couple of folks that we brought in specifically on this. The guy that's actually running this for the CUSO right now, his name's Doug Fari. He has done this type of lending in the past before, and so has deep expertise and knowledge of this space. Student Choice has today roughly 75 full-time employees, and so we're leveraging a lot of that capacity to help us in this new area of lending.
Now, when you were kicking this idea around with credit unions, what were the naysayers worrying about? And why aren't they worries?
It was mainly just in understanding risk, right? Because everyone loves the mission. Everyone believes that this is something that if we can help as credit unions come in and make a difference for these folks, again, supporting credit unions in their drive to improve the financial resiliency of working Americans. By the way, at the same time, dramatically grow new members at the credit union. There's excitement around that. But Scott, how do we make a unsecured loan to someone with poor or no credit that's living paycheck to paycheck at 18% or less, interest rate, and see that perform? Like for most of the credit unions we're talking to, they're not doing this for grow some big loan portfolio it's going to be niche, right? These are small dollar loans. These are, $1,000 to $5,000 loans. The opportunity is the relationship with the employers and expanding those, if in some cases, new relationships with employers and the new members that can come from that. The risk, I think, is sort of knee jerk, and the light bulb goes on when you really fully wrap your arms around it and understand the payroll connectivity and why that's so important for performance. Because if you just make a loan to someone, maybe it's an existing member or someone that becomes a member for $5,000 and don't do a credit check, right? The chances of a whole portfolio of those loans performing well is probably not very good. Right. And especially, credit unions, if it's not a payday loan alternative loan, you're capped at the 18% interest rate anyway, per the regulations. It doesn't really work well. So the payroll connectivity here really, really is the key. And your underwriting is based upon the likelihood and probability that that person is going to still be employed at that employer 12 months from now. And then all of a sudden the light bulb goes on and you're like, I get it. I totally see how that works. And so that's sort of the not, I wouldn't say barrier, but that's sort of the first thing we want to be sure that the credit unions really understand about, and again, this has been done before. We're not pioneering something new. It's just credit unions haven't been in this space. This is the experience of other lenders that do this type of lending as an employer-sponsored benefit with payroll integration with employers across the country quite successfully. One of the things I didn't mention that we're also very excited about is that this is also a credit-enhancing loan. So, we're not pulling credit for underwriting, like I've said, but we will report payroll-deducted payments to the bureaus to help employees improve their credit history. So again, ratings are improving, with the mission here, the financial resiliency of working Americans, their financial wellness. How can this loan actually help people improve their credit? And this is one way we're planning to do that.
Well, one issue with credit unions is that as a group, they're extremely risk averse. Some years ago, I was doing a story and I was talking with one of the big three banks that had been defrauded for under $1 million, but it was a pretty clever technique. And I was talking to them and they said, well, we'll tell you about this, but this is such a trivial amount. Why are you asking? Where credit union with $1 million is a lot of money to a credit union, even a big one. They freak out about that. Whereas this was, hey, come on, man, it's lunch money or something. Go away.
Yeah.
And
Well,
$5,000 is really trivial, to be honest. It's a trivial amount of money.
Yeah, but again, this is designed to perform. I mean, we certainly recognize that performance is critical. The credit unions want to do.
Oh, I'm not saying you should issue a bunch of paper, 98% of which defaults. I'm just saying if there is a default, it's not going to put your institution at risk. I'm pretty much guarantee you that, particularly your
no
owner institutions.
No, yeah. And this is like I said earlier, this is most likely for most credit unions to be very niche part of their loan portfolio, right? It's more about the relations.
This is actually a member benefit. It's an employee benefit more than it's a profit center, I think.
It'll be an employee benefit for the employees that have this solution through the credit union, for sure. It's less about that for most of the credit unions we're working with. This is seen more as a member relationship generation opportunity.
That's
new
I
members.
See it. If an employee is worrying about how am I going to get to work because my transmission exploded and I don't have the $5,000 the shop wants to fix it, that employee is not a good employee. They're spending all day fretting about that money that they don't have. If you could lend the person the $5,000 and then get their transmission fixed, they'll become better employees. It's worth it.
100%. Yeah, 100%.
When I was younger, I went through periods of worrying about what are really actually fairly trivial amounts of money, but I didn't have it. So you worry about that.
Mm-hmm.
Now, do you have a second product in your portfolio that you're going to roll out?
Well, so we have, once you're integrated within the employer benefits platform and the payroll integration, there's lots of interesting things you can do. So I can't give too much detail. I can say this because we're working on this right now. Let's say you've had one of these loans, right? And now you've successfully paid off that loan through automatic payroll deductions over the course of a year. What if the member can opt in to have that same amount, whether it's, $50 or paycheck or whatever that has been coming out, go into a credit union savings account once the loan is repaid, right? So, automate the savings as well as not just the lending repayment as well, so that hopefully the next time that person has a financial shock or something that happens, maybe they don't need the loan. Maybe they just go to their savings account that's been accumulating via their payroll deduction. Right. The other thing that we're looking at is direct deposits. The credit unions are very excited about this, as you might imagine. Well, these are employers that we have relationships with and their employees that have access to this benefit. What if there was, some incentive for that employee that's getting this loan? What if they had direct deposit with the credit union, right? Maybe it's not an 18% interest rate. Maybe it's 14%, or maybe it's 10, maybe it's less, right? On a $2,000 loan, that interest rate isn't that much money in terms of dollars, right? So the credit union would be foregoing a certain amount of dollars on the interest rate over the course of that year, but maybe they're getting direct deposit now from that employee, right? And and it used to be, and I think it still is, direct deposit is sort of seen as that, okay, who my primary financial institution is the bank or credit union that I have my direct deposit go to.
Yeah.
So again, the opportunities here that people are excited about are way beyond just this loan. We know the loan is addressing an immediate need that the employer and the employees have, but the opportunity to expand to new members and new member relationships and where those can go are pretty exciting once you're integrated with the employer and as part of this benefits channel and payroll integration.
Before we go, think hard about how you can help support this podcast so we can do more interviews with more thoughtful leaders in the credit union world. What we're trying to figure out here in these podcasts is what's next for credit unions. What can they do to really, really, really make a difference in the financial scene? Can't all be mega banks, can it? It's my hope it won't all be mega banks. It'll always be a place for credit unions. That's what we're discussing here. So figure out how you can help. Get in touch with me. This is rjmcgarvey@gmail.com. Robert McGarvey, again, that's rjmcgarvey@gmail.com. Get in touch. We'll figure out a way that you can help. We need your support. We want your support. We thank you for your support. The CU 2.0 podcast.